Welcome back. Let's get into that stock market movement now. And markets seem to struggle for traction earlier today. And oil even began to drop this morning as US-China spat over the origin of the coronavirus put the brakes on optimism about an economic restart as countries around the world eased their restrictions. And also then, markets did begin to experience limited liquidity with China and Japan on holiday today. Shares outside of Japan, though, did manage to fall 2.5%, unfortunately, pulled down by the Hang Seng in Hong Kong, which returned from a two-session holiday with its biggest drop in 6 weeks. Now, the moves did extend what was a sour start to May, which began on Friday, of course. There was a bleak U.S. set of data and the threat of fresh trade war hostilities, between the world's two biggest economies. An increase in tensions then between Washington and Beijing comes as this pandemic wallops the world economy. Asia's factory activity also ravaged in April, and the outlook dimmed even further as restrictions on movement to contain the coronavirus outbreak froze global production and slashed all sorts of demand. Taking a look then at how that market picture does look, it's a sense of negativity when one features out in the Hang Seng there, which by the end of the day closed out 4.2% then by the close of trade today, if we take a look at that figure. Over in Europe then, well, things managed to unfortunately then tumble along as investors returned from a May Day break to a fresh spat between the United States and China over the coronavirus crisis that began to trigger losses in cyclical sectors. Oil and gas, automakers, banking, and even technology indices were the biggest drags on the indices, falling between 3.6 and 5%. Germany's ThyssenKrupp slumped 13% after a report that the pandemic could cause a new financial squeeze, despite the sale of its elevator business, adding to US President Donald Trump's threat last week to impose even further tariffs then on China. Secretary of State Mike Pompeo also said on Sunday there was a significant amount of evidence that the new coronavirus emerged from a Chinese laboratory. So it gives you a sense of negativity out in Europe as well. Then, as you can see, all those markets going down, nearly 4% down as well for the CAC 40 out in France, while the DAX out in Germany is 3.4% lower as well there, while the FTSE 100 just inching down this afternoon. General picture, though, a sense of negativity across the board, even on the local indices. If we take a look at the JSE All Share, that's down 3.5% early today, with the banks sort of leading that fall, nearly 7% down. And we'll talk about the banks in not so long from now. So if you take a look at the right-hand first column there, the top right column there, you'll see banks going down 6.68%, nearly 7% down. Gold miners, the only one seemingly seeing a sense of positivity there, going up 0.8%. Financials are also down 5% there. Overall, on the currency picture, that's your top left-hand side of the screen, the rand at 18 rand 67 against the US dollar. It is much better today compared to where it was yesterday and in previous trading conditions. Brent crude, that's the oil price then, is sitting at $25.80 a barrel. Today it is down 2.42%. The questions around the origin of the coronavirus certainly hurting and impacting that price right now. So that's where your commodities then sit as well. All right. Hopefully we can chat to Gary Boyson in just a bit with regards to this market picture and just how things are faring when it comes to what it is that is actually moving this market. Let's chat to Gary then, who joins us on the line now. He is from Rand Swiss. Gary, it's certainly been a difficult time for markets just with COVID-19. Now with questions around the origin of the coronavirus and the spat between China and the US flaring up again, clearly it's going to get even more difficult.
Yeah, absolutely. Looking at it with, obviously with the kind of political back and forth between the US and China, it's definitely thrown markets back into a risk-off environment, and that helped to bring stock markets down the world. What we've got as well is we've obviously got the currency weakening on the back of that. Again, it's just risk-off trade as that kind of spat between the US and China continues. I think everyone kind of, with the advent of COVID-19 and with the widespread infections, we've kind of forgotten the backdrop to this. And the backdrop really is that the US and China were just coming out of a trade war, and they had essentially declared a truce, but very little had been resolved. That certainly got the markets concerned again.
Yeah. Do you think then this riles up markets all over again? It seemed we were sort of finding a sense of stability, particularly out in the United States. We saw the last month, the month of April, being the best month they've had in about 33 years or so. So do you think then we're almost back to square one in a sense?
I don't know if it's back to square one. Remember that at the same time we've got the Fed tapering its asset purchase program. The initial reaction to the coronavirus was very, very sharp and very, very quick. So the crash that we went through was one of the fastest crashes in living memory. Now, certainly, I think it's one of the fastest crashes in stock market history of that scale. Now, what we've had is a dramatic recovery in April offloads. So part of that has been fueled by central bank buying. What we've had now as well is that the Fed has been tapering its treasury purchases. They were doing about $75 billion at their peak, and they're only doing around $8 billion at the moment. That's helping to, I think, allow markets to almost subside and trade more naturally. So, our reading of the market at the moment is very much that you got the initial sell-off, which was predicting the effects of lockdowns, but predicting the effect of the coronavirus on the real economy. What we've had now is markets bouncing back partly because of the increased liquidity from the central banks, but we've seen a continued slide in the expectations around on-the-ground economic activity. Output is going to decline. Businesses are going to be under pressure. Consumers are not going to be spending as much, especially if they're concerned about where the next paycheck is coming from. In that environment, it's very difficult to tell what happens next. If you see further withdrawing of support from the central banks, there's a good chance this market corrects and trades significantly lower than it is now. A lot of, I think, the recovery that we've seen is just pricing in one, the liquidity, and two, potentially a recovery 2-3 years out. But without that kind of support, I think we are going to see it coming down more aggressively.
All right. So what happens, though, to the oil price? I mean, that sits right now where you had seen these production cuts coming into play officially on the 1st of May. So just last week, Friday, hoped that would perhaps make a dent in the price. It's still sitting at $25.80, not even hitting that $30 a barrel mark.
So if you look at oil, oil is a physically traded commodity. So obviously, actually taking delivery of barrels of oil has really been the issue, and that's what's kept a lid on the price. Obviously we had the likes, some of the U.S. traded products like West Texas Intermediate trading negative. Obviously, as we reach what's called tank tops, and that's just literally there isn't enough storage. At the moment, we've seen that production has been being cut aggressively. So if you look at rig counts, you've seen rig counts coming down around the world. You saw the likes of Norway cutting production, in almost an unprecedented cut. Now, Norway only makes up about 2% of the world's oil output, but a 13% cut from Norway is significant. It's a significant signal that it's not just Saudi Arabia and OPEC Plus that's controlling the supply of oil. At the same time, I don't know if I'm sure you were out as I was, as restrictions from the lockdown and we move into level 4 ease and you start seeing more cars on the road. You see economies, at least both locally and internationally, starting to pick up. The demand is going to come back for oil. The problem at the moment is really, I think, the access of investors to be able to speculate on the price. If you look at oil, let's say, 6 months out to a year out, you would expect prices to be a lot higher than they are now. The problem really is the physical delivery of the oil. If you go and buy oil contracts, if you go and buy an oil futures contract, you are going to need to take physical delivery unless you can roll that contract. And with contracts trading negative a couple of weeks ago, I think people are very concerned to take that type of bet in the market. You also look at USO, which is one of the largest oil tracking funds in the market. I mean, there's a potential collapse as the ETF rules change around that fund. What I'm trying to say is that it's not as easy to take that speculative punt on oil for investors as potentially it might seem. And that, I think, as well, is keeping the lid on prices.
So are we saying this is the new normal then, Gary? Is this is $25 to $30 a barrel, plus minus thereabouts, the new normal for the oil price for some time to come?
I think, in the short to medium term, I think you are going to see a lid on prices. It really comes down to how fast oil supply is taken out of the market. So if you see, as I said, you've already seen rig counts coming down, you've already seen production taking out. If that overshoots and we see a strong recovery in demand, in a post-COVID-19 world, there's every chance that the supply-demand balance is disrupted and, almost the other way around, where they've cut too much production and we see the demand side of the equation bouncing back a little bit firmer. And then there's a very good chance that the squeeze is higher. And I mean, you could quite easily see $40, $50, $60 a barrel. I really don't see that as unusual, especially considering the likes of Saudi Arabia, which has always really been kind of a swing producer. They're the producer that has the control, to influence prices. They might be able to, pump at some of their wells at sub $15 a barrel and make it profitable.
Sure.
The problem is that their state is not profitable at that level. They need around $80 a barrel oil. So if that's the case, I would assume that on, let's say, a 3-year view, you would be well above $50 a barrel again.
Yeah, here's a conundrum, though. Then you get the likes of Sasol, who are bound to suffer from this, right? So the oil price stays at these levels. Yes, they've begun to hedge things a little bit more with regards to the price of oil. They had hedged it at $32 a barrel. And now you get it sort of hovering in and around these levels. It's not too bad. But then they have to sell a stake in Lake Charles. One would have hoped that that was their saving grace. It seems that's not to be.
Yeah, Sasol's an interesting one because obviously you've got that hedge in place. Now that hedge is only for 1 quarter, and they've hedged it with a put option as well. So essentially, they're not taking they're not going to they've essentially funded their premium, which means they've paid the cost of that hedge up front, and they don't. If the oil price does spike to $60, $70 a barrel, they're not necessarily going to be damaged because of that. But given what's happened at Lake Charles with the cost overruns, given obviously the lower oil price even prior to putting hedges in place at $32 a barrel, this company has been through the ringer. It's been through all sorts of problems. Now, it really is a survival story for Sasol at the moment, and I think, we've been looking at it. I mean, obviously they were coming to market, with the rights issue. From the analysts that we've chatted to, it seems like they haven't raised, they're not going to be able to raise enough capital through the rights issue, which means asset sales. The problem is, I think anyone that is in the position to go and purchase those sorts of assets knows exactly the position Sasol is in at the moment, and it really becomes, I suppose, almost a political thing between the lenders and the potential buyers, because they know just how much trouble Sasol is in, and they are going to get that project on cents on the dollar. So
would you get in? Would you buy into Sasol at these rates? And for a long-term view, of course.
No, we don't. I don't hold Sasol personally, and we don't hold it in any of our managed funds. And one of it is just it doesn't fit our mandate. That's it. Like many people, many retail investors that we service via our stockbroking offering are trading it. But I think they're taking very much a view that this is probably not a buy and hold story. It's a very, very volatile share at the moment. It's down obviously 9% today. We've had clients buying at 40 and selling at 80 and doubling their money in a couple of weeks. Now that seems to be more the attitude from the retail investor, that it is very much a short-term play on the volatility, rather than any sort of belief that Sasol is potentially going to be that 600 rand a share that it used to be. Once
one of the defensive stocks as well on South Africa's stock exchange is unfortunately now being reduced to a short-term play of this nature. Gary, appreciate the time. Thank you so much for it. Gary Boyson is from Rand Swiss. They're helping us unpack that market picture. As we get into grips with just how the world is right now, the new normal, right? We'll unpack a little bit more about Sasol and some other companies as well making news this afternoon. Back right after this.